Well, one of the good set of numbers in the auto space came in from Sona BLW Precision Forgings. The company reported a solid set of numbers. Revenues went up 16%. Margins went up 360 basis points to 29.7%. The company's net order book has also increased. And, the company has now a higher presence in the electric vehicle space. Rohit Nanda, who's the Group Chief Financial Officer at Sona BLW Precision, is joining us. Rohit, thanks for being with us on the channel. Appreciate your time here. First, if you look at the 9 months performance, right, it's been very strong. Revenue growth of almost 20%. And now you're sitting on a base of around 2,300 crores. What is the full year revenue outlook, both FY24 and what can you reasonably do in FY25 as well?
Good morning, Sonia. So we actually normally don't give the revenue guidance, but going by, how we've performed, let's say over the last 10, 15 years, we've grown at a 25% CAGR plus. And based on the order book and the current outlook, I think that is something which should be maintainable.
Okay, so you're going to grow at a 25% compounded growth over the next few years as well. That's what you're looking at. But, your order book, just to talk about that, has increased to 22,400 crores in Q3. How much of this will be executed in FY24 and 25?
It's actually 24,000 crores.
Okay.
I think most of the large orders, I will say, will start production by FY26. So it will happen every year. I do not right now have, let's say, a year-wise breakup, but by FY26, most of the large orders would be in production.
Got it. So good morning. Just a quick word on the contribution from EVs. I think it's now just under 30% of your overall revenues. Could you give us an update? Is it growing as you'd like? What's the rate of growth, and where do you see this in FY25?
Sure. So, EV continues to be our biggest growth driver. If you look at our order book also, 80% of the order book comes from electric vehicle segment. So we feel that this will continue to be our key growth driver in future also. In fact, we have an ESG target to do 45% of our revenue by calendar year 25. It should be 45% of our revenue.
And how much of this is this 80%? How much of this is India?
India, I think, should be about 15%. It's around 12 to 15%.
Is there a big difference between margins you make on EV work here in India and overseas, sir?
Look, the products that we supply in India are different than the products we supply overseas. So there is a difference in the margins, but the products are also different.
So what's the margin difference then, Mr. Nanda?
Well, we do not actually talk about product level margins, but overall margins is what we generally talk about. And that's where we feel that we'll be able to maintain the margins given the order book constituents.
But I believe you've gone ahead and you've upped your margin guidance as well. So you're feeling fairly confident on that front. Tell us what are the factors that are in play?
So, Nigel, we generally, we have always said that our margins range between 25 to 27%, 28% actually. But for the last few quarters, we actually were doing the margin on the higher side. So we've kind of revised it slightly upwards. So partly because of the disinflationary factors, because when the material prices go down, although we have a material pass-through arrangement with the customers, but in terms of percentage, the margin gets a bump up. Apart from that, the product mix and operational efficiencies are also kicking in. So we feel that 28% should be maintainable in the foreseeable few quarters at least.
Okay, that's interesting. I think that's what the street also likes. The stock is up about 1% now. So you're saying, from an earlier band of 25 to 27%, now you're confident that 28% margins is what you can maintain. But there's also some aggression in terms of pricing, right, in the electric vehicle two-wheeler space, with a lot of the new players getting ready to launch now. Ather is launching a new bike as well in April in the family segment. So there's so much coming through in the next couple of months. Do you feel that pressure in terms of pricing, and could that derail your margin targets a bit?
No, so yes, I know what you're talking about. So there has been a sort of a pricing depression, so to say, in the Indian two-wheeler market. But one, we feel it's temporary, cannot be maintained. And secondly, we are well diversified across the industry. So we actually have about 14 odd customers with whom we have orders, and of them, I think we are right now producing and supplying to 4 of them. So our order book is fairly diversified. So we don't feel that it should be a long-term phenomenon that prices are aggressively cut. And secondly, we feel being well diversified across multiple customers, that should also help.
Rohit, this EV margin business, it goes to the heart of the question for EV makers as well. Would margins be comparable to ICE petrol products and ICE engine products? Because there is technology, there is innovation, you've got to do all of that, right? At least here in the Indian context, it's mostly assembly when you look at EVs. So can margins be comparable, or will there be a big difference?
Look, if you're talking about our margins have actually not gone down, though, as I said, our key growth driver has been sales to the EV segment. But if you're talking about the end vehicles, then that's a different sort of context.
But even for you, you're saying that there is a difference, but you don't want to disclose that between products which you export and products which you supply here on the EV side.
Yes. So there is a bit of difference. Also, it comes from the way market is positioned. So in case of, let's say, what we export mostly, the driveline products. So there is massive technological, let's say, differentiation, value addition that we do for the customer. So even for the domestic segment, there is value addition, but in terms of product categorization, the differentiation is not as much from the technological standpoint. So that's where we are trying to innovate also. And you might have seen that we have recently won a contract wherein we'll be supplying an integrated motor controller for the first time in India to a traditional two-wheeler manufacturer in India for their electric bike. So we are trying to do that, to do value addition for the customers, thereby trying to create some differentiation for ourselves and for the customers.
That's interesting. In Q3 itself, you won 5 new EV programs, including onboarding 2 new EV customers in 1 quarter. That's quite a bit. I mean, is it lumpy, the kind of order wins that you're getting, or is it sustainable? Just trying to understand what was the total quantum of orders of these 5 new projects, and what could the run rate be in EVs over the next few months?
So look, order intake can be lumpy because, before we win the order, the work that goes behind that can range anywhere between 6 months to 1.5 years, because we need to work with engineering teams of the customer. So these are mostly customized products. So generally, it's not like a steady state that every quarter we will have a run rate order win. But yes, there can be quarters wherein we may have lumpy order wins. And in this quarter, we had 5 orders. But we've actually been, if you look at our order book, we've been adding to our order book ever since we've got listed. We've been publishing these numbers. So if you look, let's say, beyond quarter to quarter basis, you would see that our order book has grown. I think when we got listed about 2.5 years ago, our order book was about 13,000 crores. Now it's 24,000.
24,000 crores. Yes, absolutely. That's been a good growth. Even your market share, right, in key segments, whether it's differential gears, whether it's starter motors, your market share has gone up quite a bit. So can you tell me, overall, is there scope to improve market share further? And if yes, any kind of internal targets that you'd have?
So there are no targets, but yes, growing market share is one of our key strategies, because if you look at the underlying market, the automotive market, if you were to take a base of 2019, which was the peak year for the global automotive market, so it's still lower than that. So it's not grown in the last, let's say, 4 or 5 years. So intermediate, I mean, you will have 1 year of growth and probably 1 year of decline. So the only way you can grow is to get into new products. You can increase your market share, etc. And this I'm talking more on a macro basis, on a global level. So that's a key strategy that we have, that we need to grow our market share. And our sense is that though there is no research or anything that goes behind it, but based on how the market is structured, I think 15% market share may be generally, what we consider as a cap, beyond which it becomes difficult to grow.
Okay. All right, Mr. Nanda, good to hear your thoughts. The market, I think, likes what you're saying. You're sounding optimistic on business prospects. Wishing you all the best, and we look forward to chatting with you all through 2024 as well.